This video will explain how the goodwill calculation in Activity 13.1 ties into the consolidation journal entries that we prepare in Worked Example 14.3. It is best to watch this video after you have attempted both the activity and worked example. Refresh your understanding of the facts before proceeding. And please note that not all of the activity is being covered in this video. Stark Industries acquires an 80% controlling interest in TBS on 1 April 20x2. There is also a 20% non-controlling interest. IFRS 10 requires consolidation journal entries to reflect the group as if it was a single economic entity. That's why the 20% non-controlling interest, or NCI, is part of the group and pictured within this circle. It is 15 months since Stark acquired TBS, and we are focusing on the preparation of the consolidated financial statements for the year ended 30 June 20x3. In this video, we will cover the goodwill calculation using the full goodwill method, allocating the goodwill between the parent and the non-controlling interest, the consolidation entry to recognize the goodwill asset, plant and equipment consolidation journal entries, the contingent liability entry relating to a lawsuit, and the elimination of the investment asset entry. This video covers a range of issues, and you can choose to watch the parts that you find challenging. The worked example does not cover the NCI entries, so we won't cover that in this video. There were not enough facts presented to calculate the NCI. Here we have the goodwill calculation at two dates: 30 June 20x2, when the first consolidated financial statements were prepared, and 30 June 20x3, which is the period that we are focusing on in this worked example. Take time to understand the goodwill calculation. It's not simply a calculation. The value of the goodwill will be included in our consolidation journal entries and will appear as an asset in the consolidated balance sheet. The consideration transferred is calculated in the activity as $4,297,160. And we can see from the facts here that the non-controlling interest is measured at its acquisition date fair value. So we're applying the full goodwill method. And this fair value is given to us in the facts. Moving on to the major part of the goodwill calculation, which is calculating the fair value of the identifiable net assets. We can see that the starting point is the $4,740,000 book value of the net assets acquired. This is the value recorded in TBS's general ledger at the acquisition date. Look at the balance sheet values of TBS at the acquisition date, and you can see that this is the equity side of the balance sheet, showing the share capital and retained earnings, and that is simply the flip side of this $4,740,000 net asset value. We need to make acquisition date fair value adjustments for plant and equipment and for a contingent liability. IFRS 3 generally requires fair values to be recognized when calculating goodwill in a business combination. As the plant and equipment's fair value was higher than its book value, we add this $196,000 after-tax adjustment. The main complication in this goodwill calculation is the contingent liability. At the acquisition date, TBS was defending a lawsuit. Stark would have been aware of the lawsuit, and this would impact the price that they would pay for their interest in TBS, and accordingly that will impact the value of goodwill. Now notice how the contingent liability value is subtracted in this goodwill calculation. IAS 37 does not allow the recognition of a contingent liability on the balance sheet. So TBS would only disclose the contingent liability as a note in its financial statements. Therefore, the contingent liability isn't included within the $4,740,000 book value of the net assets. IFRS 3, however, requires the fair value of this contingent liability to be included within the goodwill calculation. At the acquisition date, the fair value was measured at $150,000, resulting in a $105,000 after-tax adjustment in the goodwill calculation. However, there was a measurement period adjustment, as the settlement of the lawsuit resulted in new information. This means that the 20x3 goodwill calculation adjusts for the $140,000 settlement of the contingent liability, and this results in an after-tax decrease of $98,000. Allowing for the measurement period adjustment, the fair value of the identifiable net assets is now $4,838,000. It might help you to think that the fair value of identifiable net assets is what TBS was really worth when Stark acquired its controlling interest. From the $5,277,160, which is the sum of the consideration transferred and the fair value of the non-controlling interest, we subtract the $4,838,000 fair value of the identifiable net assets to give us goodwill of $439,160. You can see that this is different from the 20x2 calculation, which was $446,160, and that's because of the contingent liability measurement period adjustment. The value of the goodwill at 30 June 20x3 is $439,160. This is the value of the asset that will appear in the consolidated balance sheet. As we're applying the full goodwill method, we need to work out how much of that asset belongs to the parent and how much belongs to the non-controlling interest. We perform this split as it will have implications for our consolidation journal entries. The top part of this table is summarising the information from our previous calculation. Now we split the asset between what the parent owns and the amount of that goodwill that belongs to the non-controlling interest. The parent's share is calculated as the $4,297,160 consideration transferred, less the 80% share of the fair value of the identifiable net assets that Stark acquired. So this value is $426,760. That's their share, the parent's share, of the $439,160 goodwill asset. And this value, the $426,760, is the same amount that we would calculate if Stark had instead chosen to apply the partial goodwill method. The remainder is the amount that belongs to the non-controlling interest, but we can calculate it in a similar way. The fair value of the non-controlling interest at acquisition was $980,000, less their 20% share of that fair value of identifiable net assets, resulting in their share of the goodwill asset being $12,400. So that's their value. It's important to understand that we don't simply split the total $439,160 and apply the ownership interests of 80 and 20% respectively. The calculation for this split is a little more complicated, so please take time to understand how you perform the calculation of this full goodwill value being split. The first consolidation entry that we are recording is to recognise the goodwill asset. Stark's acquisition of TBS was 15 months ago, but we're doing the consolidation at 30 June 20x3. Every time we prepare consolidated financial statements, we have to repeat a number of journal entries to reflect acquisition date fair value adjustments and the recognition of goodwill. This is because our consolidated journal entries do not carry forward. The parent and the subsidiary maintain separate general ledgers, but when the consolidation is performed, it may help to think that each company's general ledger trial balance is copied into an Excel spreadsheet. All consolidation journal entries are only recorded in that Excel spreadsheet. Next year, when the next consolidation is performed, entries will need to be repeated, as the company's individual general ledgers are not altered by these consolidated journal entries. The consolidation entry uses the 439,160 amount from our goodwill calculation, which was the value taking into account the measurement period adjustment. Remember, this is the full goodwill value, not the parent share. We debit 439,160 to goodwill in the balance sheet and credit the consolidation suspense account called the BCVR account, or the business combination valuation reserve. This suspense account sits within equity, and we will start to eliminate it in a later consolidation entry. Once we have posted all of our consolidation journal entries, including those relating to the non-controlling interests, the BCVR should come back to having a zero balance. Think of this suspense account as a way of helping us to get certain acquisition date values into our consolidated financial statements. And we don't recognise a tax effect adjustment for the goodwill, as IAS 12 prohibits this when goodwill is acquired. Moving on to the entries relating to the plant and equipment. In the goodwill calculation, we saw that there was a fair value adjustment required for plant and equipment which the subsidiary didn't record in its general ledger. First, we offset the $80,000 in accumulated depreciation at the acquisition date of 1 April 20x2 against the cost of the plant and equipment. This brings the acquisition date plant and equipment down to a net carrying amount of $920,000, which is the cost of $1 million and accumulated depreciation of $80,000. IAS 16 requires this entry when an asset is revalued. The second entry lifts the plant up from the $920,000 net carrying amount by $280,000 to bring it up to the acquisition date fair value of $1.2 million. Think of this entry as accounting for a difference rather than it being an elimination entry. As the asset side of the balance sheet increases, we recognise a future tax impact. So that's why we have a credit to the deferred tax liability account on the liability side of the balance sheet. And the balance in the journal entry is a net $196,000 credit to the BCVR account. Remember, that's a suspense account that sits within equity. And notice how the $196,000 credit is the fair value adjustment to plant and equipment that we saw in the goodwill calculation. It is 15 months since the acquisition, and the plant and equipment declines in value. We need to make depreciation adjustments given the $280,000 fair value adjustment we've just made to the asset. Drawing a timeline can help you to understand the facts which will lead to your consolidation journal entries. There are 3 months in the first reporting period, up to 30 June 20x2, and there are 12 months in the current reporting period. In the subsidiary's general ledger, it is still recording the asset and the related depreciation based on the cost, not on this $280,000 higher fair value that the group is recognising for the plant and equipment. Its remaining useful life from the acquisition date is 5 years or 60 months. Therefore, an extra $14,000 in depreciation will need to be recorded in the first 3 months after the acquisition up to 30 June 20X2, and for the most recent financial year, the depreciation adjustment is an extra $56,000. As consolidation journal entries don't carry forward, we need to record entries for both the current and prior year depreciation adjustments. The current year depreciation expense gets increased by $56,000, so a debit to depreciation expense. And last year, when we did the consolidation, we would have increased last year's depreciation expense by $14,000. Last year's depreciation expense is now sitting in opening retained earnings, so the debit is to opening retained earnings. Correspondingly, there is a $70,000 increase to accumulated depreciation. When you change consolidated profit, you need to consider the need for a tax effect entry. The debit to depreciation expense reduces profit. Reduced profit should be matched by lowering income tax expense for the period. $56,000 times 30%, or $16,800, is credited to income tax expense. A credit to income tax expense reduces the expense. Last year's consolidated profit was reduced by $14,000. So last year's income tax expense, which is sitting in opening retained earnings, also needs to be lowered. Hence the $4,200 credit to opening retained earnings. The balance in this entry is a debit to the deferred tax liability account, as the DTL recognised in our earlier entry is starting to reverse. It is incorrect to record the debit to a deferred tax asset account. Let's look at the contingent liability adjustment. This adjustment can be challenging to understand. TBS was a defendant in a lawsuit before it became a subsidiary of the Stark Group. The matter subject to the lawsuit happened before Stark gained control of TBS. Maybe the matter was that a TBS employee suffered a workplace injury back in 20X1. The Stark Consolidated Group was not responsible for that workplace injury, but Stark was aware of it at the acquisition date, hence the adjustment that we saw in the Goodwill calculation. The Stark Consolidated Group is responsible for paying the cash for these damages, but the Stark Group's consolidated profit should not be affected given that the workplace injury happened back in 20X1 pre-acquisition. So TBS would debit damages expense and credit cash when it pays the $140,000 settlement amount in October 20X2. So there's the entry that you would see in TBS's general ledger. You can see the $140,000 damages expense from their general ledger in this consolidation worksheet that I've prepared. However, from a consolidation viewpoint, this expense is pre-acquisition to the Stark Consolidated Group. We will need to eliminate the expense along with the related tax effect. The consolidation journal entry will credit $140,000 to the damages expense to eliminate it in order to bring the group's damages expense down to zero. Similarly, we'll match the increased profit with increased income tax expense by debiting $42,000 to income tax expense. So you can see that when we credited damages expense, that credit is affecting profit, therefore we match that by increasing income tax expense, therefore we debit it. The balance in the entry goes to the BCVR account, as this is one of our acquisition date fair value adjustments from the Goodwill calculation. The consolidation journal entry does not impact any balance sheet assets or liability accounts, and this is because the damages claim has now been settled. Lastly, we need to eliminate the investment asset. This entry needs to be performed every time consolidated financial statements are prepared. Perhaps the starting point when you are doing a large entry is to start with an easy line. Looking back to the acquisition analysis, we see the $4,297,160 of consideration transferred, or investment cost, that would be sitting as an asset in Stark's general ledger. This asset needs to be eliminated to avoid double counting, hence the credit to the investment in TBS. Next, eliminate the share capital and pre-acquisition profits that Stark acquired at the acquisition date. Stark purchased 80% of TBS's share capital and retained earnings on 1 April 20X2, and we can see that in the pop-up there from the facts in the question. We debit share capital $800,000 and debit opening retained earnings $2,992,000 for the 80% that Stark acquired. Stark has not earned those profits, it acquired them, and that's why we're eliminating them. Looking at the remaining debits and credits in this entry, you will notice that they are all made to the BCVR suspense account. Some of the earlier consolidation entries were debiting and crediting asset and liability accounts, but they also impacted the BCVR account. Let's start to clear this BCVR suspense account. We eliminate from the BCVR account the parent's share of the goodwill. So debit BCVR goodwill $426,760. Eliminate the parent share of the plant and equipment fair value adjustment. Debit BCVR plant and equipment $156,800. Eliminate the parent's share of the damages contingent liability adjustment. Credit BCVR lawsuit $78,400. If the worked example provided more information, we could have prepared the non-controlling interest journal entries. These would include the allocation of the NCI's $12,400 share of the goodwill asset, as well as the elimination of the remaining values that are sitting in the BCVR suspense account. Thank you for watching this video. I hope that it's helped to clarify the activity and worked example.